Much for your time. I really appreciate it. It's such volatile. It was such a volatile environment that we're finding ourselves in. And despite the strong economic recovery that we saw in 2020 post-COVID, and then following the 2021 year, we've seen a severe pullback in global markets since returning to our seats. Well, since us returning to our seats in January this year, predominantly driven, obviously, as we know, by the tensions between Russia and the Ukraine. Many countries facing enormous and increasing debt burdens, high global inflation, and major geopolitical tensions. Darby, would you mind just taking us through a not as rosy as we would like for it to be global picture? Where are we? What is your interpretation of what's going on, and what is it that we should be looking out for?
Yeah, thanks, Luciano. I think let's start off by saying that we live in a free market system, and a free market system is a system that continues reinvents itself. And although we're going through a very difficult time, this is actually good. It's actually good for a free economy. It's good for a free market system, because in the process, what is happening at the moment is that we are recycling capital that is not adequately employed somewhere else in the system. So I know it's very painful if a business goes under. I know it's very painful if an economy goes into a recession, for example, but that's a requirement for laying the foundation for the next upswing. All right, let's just understand how we got to where we are. You're absolutely right. It was just after the lockdown, all the economy started roaring back to life again. And that happened in an environment with exceptionally accommodative monetary policy, which means very, very low levels of interest rates globally, as well as funny things like quantitative easing. And governments also started stimulating the economies as much as they possibly could. The Americans, I think Biden is a very good example of that, where literally sent checks to the citizens in the United States. And the result of all this opening up and this surge in demand resulted in high levels of inflation. Commodity prices started going up. And then Putin decided to invade Ukraine, and commodity prices went up even further. And the result of all of that, and what I'm particularly concerned about, is the high levels of food prices, the sharp increase in food prices, which is actually leading to famine in some countries in the world. Certainly not in South Africa, although we are experiencing an increase in unemployment and poverty, and absolute poverty as well. And some children are actually actually going to bed hungry in the evenings in South Africa as well. But not nearly as bad as countries like Somalia, as an example. But the big story internationally is this massive increase in inflation, and central banks made it very, very clear that they will stamp out inflation. The only real option available to central banks is to tighten monetary policy, which means that they have to withdraw liquidity out of the financial markets. Let's call it quantitative tightening. Remember that word, Luciano? We're going to hear this quite a lot over the next couple of months and years. Quantitative tightening. But the most obvious conventional instrument available to central banks is to increase interest rates, and that's exactly what they've done. But as you increase interest rates, that, of course, has got a negative impact on financial markets, because financial markets start discounting weaker economic growth going forward. And indeed, economies are growing slower already. The question is, are we going to go into recessions? And in some instances, I think that is indeed the case. So globally, economic growth is certainly slowing down. If you look at specific regions, there's a good possibility on the US economy, but there are some interesting things happening there. Maybe we can just spend some time on the US economy. But US economic growth is slowing down. There is a possibility of going into a recession in the US economy. In fact, economists are debating whether they're in a recession already or not. But one or two very interesting things that's happening in the US is that the unemployment levels remain very, very low. We haven't really seen an increase in unemployment. And also the earnings of companies remain relatively strong, which is quite surprising. So that is a bit of an anomaly. We'll have to wait and see what's going to happen there. But I think what is clear is that economic growth is going to slow down. The good news in the US economy is that it seems to me as if we are either there or close to the upper turning point in inflation in the US. I think they will continue to increase interest rates in the US. Some economists are even talking about the full 100 bips increase in interest rates. But I'm pretty sure that we're close to the upper turning point in inflation. And thereafter, we can start talking about the possible reduction in interest rates, or reduction in short-term interest rates in the US. And what I find particularly interesting, although the bond market bombed out recently again a little bit, but there are signs that the longer end of the yield curve are sort of gradually start going down a little bit. And that is a sign that short-term interest rates are more or less on the sweet spot. So I think I think the worst is over as far as the US is concerned. In the case of Europe, they've got some extra additional problems coming from from Russia again. The lack of electricity, that's pushing up unemployment, pushing up inflation in the US. They started increasing interest rates as well, or rather in Europe, and started increasing interest rates as well. And I am pretty sure that the economies will start slowing down quite significantly, and a recession is quite possible there as well. The other big economy that we need to talk about is China. Chinese economy is also slowing down, but for other reasons. In fact, they've started stimulating the economy from a monetary point of view already. So globally, we're talking about a slowdown in economic activity. There's very little doubt about that. But, and this is the good news, financial markets are quite clever. Financial markets look through the near future, try to find out what's going to happen in a medium term and a longer term. And like I've said, there are signs that the financial markets are starting to discount the possibility that the world has reached or close to the upper turning point on inflation, and the financial markets will start discounting the possibility of further interest rate cuts. As far as South Africa is concerned, I don't think we should talk much about South Africa, but economic growth in South Africa is a major problem for various reasons. And we know Eskom is perhaps the single most important reason. So in short, yes, we've gone through a very difficult time. I think the worst is probably behind us. I'm talking about the world economy and the financial market, generally speaking. I think there will be some pain ahead, inevitably. It's possible that certain regions in the world could dip into a recession, which will impact negatively on South Africa. Interest rates will go further, but the financial markets discount all these sort of things. And I think they've discounted most of this already. So my advice to people is that, the most important factor that you have to consider is that you have to know who you are doing business with. You have to understand, and you must make sure that you have the right products and you have the right structures, and you must understand that the financial markets are volatile, and that's a risk that you simply have to learn to live with. Once you've got the right structures in place, once you've got the right products in place, go and sleep soundly at night, because the financial markets are volatile beasts. They will go up and down. That's the nature of the beast, and there's not much that we can do about that, but I believe that the worst is probably behind us.
Fantastic, Darby. Thank you so much for that backdrop. Yeah, it's not that rosy at all. Obviously, with regards to the geopolitical risk in Russia and the Ukraine, that's sort of an uncertainty. We don't know what's going to happen during winter. We just recently spent some time in Europe, and the increase in gas prices is just enormous, with in some instances up to 400%, which obviously would negatively implicate what's going on there from an economic growth perspective.
Luciano, can I maybe just make a comment about that?
Yeah.
The most likely scenario, what's going to pan out in Ukraine, is that this is going to be this is a war that's going to go on for a very long time. Despite the recent gains that Ukraine made against Russia, this is something that's going to go on for a very long period of time. And the most likely scenario, although it could be different, but the most likely scenario is this a long war that will keep commodity prices elevated, but not very, very high. So I've got a suspicion commodity prices are likely to drift lower gradually. And I think in a year's time, for instance, or less than a year's time, we could see the world price at 70, low 80s kind of thing. So that's another reason why I'm quite bullish on international global inflation. Of course, there could be another scenario. It could be, some other countries could get involved in the conflict in Central Europe as well. But the most likely scenario is for commodity prices to remain elevated, but to gradually drift lower, which is supposed to be good for inflation as well.
That's very interesting. Riaan, in a volatile environment such as the environment that we're finding ourselves in, we saw some positive days coming through, the last 4 days up to yesterday, where we saw the inflation figures out of the US that that didn't translate to what we expected for it to provide us with in terms of figures. That obviously negatively implicated the markets once again. So it's such a volatile seesaw almost, where we up a few days and then we're down a few days.
Yeah.
From an asset management perspective, how do you sort of make sense of what's going on, and how do you position a portfolio? What is it that we should be looking out for, and how do you typically approach an environment such as what we're in at the moment?
Yeah, there's a few things that we're looking out for. As you mentioned, US inflation yesterday came in at 8.3%. The market was expecting 8.1%, and we basically lost most of the gains we had accrued over the last couple of trading sessions, so basically flat for the month. And as Davy mentioned, the market is trying to suss out where inflation is peaking. Now, that 8.3% increase is a very interesting number because there's a lot of inputs that go into the inflation print. Inflation is quite a complex matter. For instance, one of the biggest increases in inflation is owner equivalent rents, which makes up about a third of core inflation. Now, nobody really pays owner equivalent rent. It's a measure that they use. What that means is that if you own a house, your inflation is a lot lower than somebody that doesn't own a house, for instance. So it's quite complex, and there's a few things that we look out for. The biggest one for us is sort of when you're a consumer, that you basically get an inflation expectation number every day. Every time you fill up your petrol tank, you get a sort of sense of what you think inflation is going to be, and you see petrol or gas prices in the US going up or down. Now, what's quite interesting for me is over the last basically 90 days, gas prices in the US have been coming down quite substantially, and that's causing a rebound in consumer confidence. So that means consumers feel a lot better. And I think that's important to note. What we see over time is that inflation expectations really track petrol prices in South Africa and gas prices in the US. So that's quite positive. People don't overspend, etc. So that's important to just take note of. Obviously, most of that has happened quite recently, so it wasn't in the inflation number we saw yesterday, but in the next one, we should see a bit more of that. And then also, of course, the two guys who don't fight is Rocky Balboa and Jerome Powell. So while the Fed is in inflation fighting mode, we do expect some volatility. That's what we're seeing. I mean, we spoke about it just now, and we expect that for the next couple of months, that is most likely going to continue. For us as asset managers, that's an environment that we like because it gives us the opportunity to buy excellent businesses when they trade at attractive prices. Maybe just moving over to Europe. This is a chart that I saw of a Deutsche Bank report yesterday. It's quite interesting, basically just showing that natural gas prices are 8.5 times higher in Germany than they are in the US. So quite expensive. That really has an impact on consumer sentiment. On businesses, a lot less so. Businesses typically use a lot more electricity and a lot less natural gas in the means of production. So that really influences where you pick your spots. If you are in the travel and leisure industry, you typically spend a lot on electricity. If you're in the chemicals industry, you typically spend a lot on energy. But other businesses really a lot less. So I think what's happening with all of these massive price movements in various input commodities and other forms of and other inputs into your means of production, how it plays out for underlying businesses differ quite a bit. So you don't have this sort of massive trend. You can really pick your spots in this environment. So one, there's clear winners and clear losers. And secondly, with the volatility, you can buy these businesses when they trade at attractive valuations. Davy mentioned the war in the Ukraine. I'm not going to spend too much time on that, but that's something that the market is becoming actually a bit less concerned about. We're seeing that, platinum prices pulling back, etc. All the commodities coming out of the Ukraine and out of Russia, the market is it's starting to move a bit to the back burner. Of course, the big thing that's the problem in Europe is this energy crisis, and you can see the greenification of the world has led to a massive underinvestment in oil and gas production. And I think we expect that to increase quite substantially. One, because governments globally got this massive fright, but two, because of the greenification of the global economy. So we expect a lot of infrastructure spend in that space, obviously also that leading to winners and losers in that environment. China also very important. As Dawie mentioned, China started to stimulate their economy in a month's time. Xi Jinping has their annual every 5 years they have their conference. He hopes to be elected for another term. It would make him elected in for 3 terms. And it's going to be interesting to see how that plays out, because one of the key problems with China is their zero COVID policy, where as soon as there's a few COVID cases, they lock down a city or an entire region. And the economy can't really restart unless we move past the zero COVID policy environment. So we expect that, at the beginning of the year, we thought China was going to grow by about 5%. We now expect China is going to grow by about 3% this year. And we really need to move past this until for us to see massive growth out of China, out of emerging markets. China typically leads other emerging markets, such as the South African market as well. So putting all of this together, what's in the price? Well, people are very negative. We can see it in asset management surveys, the likes of Bank of America asset management survey, fund managers really not owning a lot of equities. We can see it in all sorts of sentiment surveys. And as Dawie mentioned, it's our view that a lot of what we are experiencing currently and a lot of the negative market movements has priced in a lot of the risks globally. So maybe if I can just form sort of 3 scenarios, the big thing that's going to drive markets going forward is the direction of inflation. That's the number that the market's watching. We saw it again yesterday. And the sort of big bearish scenario from that is that will the Fed pivot? Are they going to stop raising rates anytime soon? If they don't, then we can expect this volatility to continue. But if they do, I think we're moving into a basis for a very strong bull market, sort of, again, a secular bull market. And that's typically that initial period of recovery. If you miss that, you miss a large percentage of the overall gains. So we are really positioning our portfolios to make sure that we capture most of that initial recovery as well. A few other, up until year end, most likely sentiment and positioning can push markets higher. As I showed, sentiment is very depressed. Overall equity positioning is very depressed. So as soon as things start to change at the margin, you'll actually see money flow into equities again, which will push markets higher. And then finally, I do also think that we are going to see this continued volatility, maybe until year end. Typically, August and September are negative months. As everybody in the Northern Hemisphere return back to their trading desks, they typically sell first and ask questions later, and then we typically recover into year end. And I think this year is not going to be much different. So that's our overall scenarios. As I said, this is an environment that actually is quite conducive towards overall wealth creation for a couple of reasons. One is that what we see in our portfolio of companies is that they're actually buying their weaker competitors, so they're expanding their market share inorganically. That's something that we like. We think it's going to be big growth drivers for them. They can reshuffle some of their underperforming businesses. They are buying back stock, so we don't have to buy more stock. They're doing that on our behalf. Most of the companies we own are generating quite a lot of free cash flow, which they can reinvest into buying back stock at depressed levels. So our clients are actually getting more stock more revenue per equity that they own. And then finally, we have a bit of cash in our portfolios as well, so we can buy really quality businesses when they trade at attractive valuations. So I think the combination of this is where we want to be. Bull markets are born out of pessimism, and everybody's quite depressed right now. So I think that this is the environment where you make sure that you make the right moves for the next bull market and make sure that you capture most of that bull market, at least quite substantially. And those are our views.
It's interesting that you pointed out. I mean, so looking at the market and how it reacts, I mean, so it's as if though, it doesn't necessarily have to be good news. As long as it's not bad news, that sort of allows the market to run, very, very quickly. And I guess, it's as you pointed out, using these the volatile environment to reposition and take opportunities. You're buying quality assets at a reduced valuation. So if you have the capital, then it might be a sensible consideration for you to move into the market at the moment at these levels. So as soon as the old saying that as soon as the music starts playing, if you had to run to the dance floor by that time, you're going to miss the song. So
exactly.
So be there whilst it's on. Thank you also for that picture. Was it of Davy or was it Rocky Balboa? I was confused for a moment. Gentlemen, thank you once again for your input. I really appreciate it. I think that gives us a lot of perspective. And to our valued clients, thank you for trusting us with the management of your capital. I think the purpose of these videos that we're sending out quite frequently is really just to give a holistic view and a bit of a backdrop. We're definitely not sitting on our hands. You've appointed us. You went through an institutional risk process where you identified a quality team to look after your assets. And thank you for choosing us. And I could confirm that, as we pointed out before, we're definitely looking after your assets, such as we've illustrated in this content. So please do liaise with us if there's anything that you need specific information or additional information on. We're happy to revert back to you as soon as possible. But gentlemen, thank you so much for your time. Highly appreciated, and I'm looking forward to catching up soon.
Luciano, maybe just 2 final comments from my side. The first is that the one thing all bear markets have in common is that they end. And the second thing is that pessimists are normally right and optimists are normally rich.
Well, that's quality take home. Thank you for that, Rian. Gentlemen, have a nice day. Good luck in the markets, Rian.
Thank you, Luciano.
Thanks for your time. Speak to you soon.